2022 was a painful year for a lot of investors. Higher valuations and a tightening monetary policy was the backdrop against which we saw the returns that we saw in 2022. The big question is, if we use the same lens, that's valuations as well as monetary policy, what could 2023 look like? And that's the question that I offer my opinion in this update. Greetings, viewers. You're watching Aman Sanga, Independent Financial Advisor in Mississauga, Ontario. Now, for my update for 2022, this is the first update for 2023. What I'll do is break it up into three components, three parts. We'll start with looking at the returns. Then we'll use the lens of valuation as well as the monetary policy to look at 2023. And lastly, I have one action item idea that the viewers can take away that they can use as to what I think will be helpful, at least for the RRSP season as it kicks off in Canada. So without further ado, let's get started with the index returns. Now, this is 2023. Now, the good news here is that there is all black here, which was not the story last year. So since that is the main focus, and now you can look at it that there was no hiding place in 2022, whether it was the bonds, whether it was the S&P 500 or the NASDAQ. There were drawdowns in all the major indexes. I mean, if you can call the TSX as a winner, as in it outperformed by not dropping as much as the American indexes. Now, this year is unique. 2022 will be unique, and it will be for the history books because there are not that many examples out there where you had both bonds and equities had the similar negative, but both negative in the same year. So you can see this 1994 was the last instance, and to some extent 2018. So that was 2022. That's in the books. We need to move on from that. The big question is, what's in it for 2023? So if we use the same lens, if you look at it from a valuation perspective, let's just look at there. The valuations have definitely come down, but have they come down enough? The Shiller PE ratio, if you look at it, on Jan 18th, this was about 29. Now this has come down significantly, but it's still way above its averages. If you look at the mean, which is 17, the median is about 16. The plain vanilla PE, it's about 21 right now, whereas the mean is 16 and the median is about 15. So they have come down. They are cheaper, but they are not necessarily cheap. Now with that, let's look at the second lens, which is the monetary policy. And the Fed has indicated that they have the intention to raise the rates to 5% or above, and that's where they're going to stay for 2023. And you can see the big jump we've had in the federal funds rate. The disconnect here is the market pricing in a rate cut in the second half of 2023. Now, there are a lot of ifs if that were to happen. I mean, whether Fed is going to stay at 5 or they're going to cut. There's a big disconnect. And what's going to drive this? Nobody knows which way this is going to play. And if anybody can get it right, this would be the most profitable trade for 2023. But if we have to use data to guess which way they are going, Fed's driven by inflation. Inflation has come down. If you look at the drop, it is definitely down, and most of it coming from the blue lines. If you see the transportation sector, the year-on-year increases are starting to come down, but the other sectors are still up. And it is still far way away from the targeted band, the targeted number of 2%. That's one way to look at it. The second way to look at it is splitting it up into goods and services, splitting inflation up into goods and services. you can see that the less volatile component of CPI, which is the core, it is starting to go down on a month-on-month basis. But for services where wages is a majority component, it seems to come down, but it's not down as yet. So how well inflation is controlled will largely determine Fed's reaction. And if Fed were to continue at 5 or higher for the rest of 2023, I think we could be setting up for a choppy 2023 as well. So a lot of unknowns, everybody's opinion. But with all this volatility around us, there is always an opportunity to invest, and that's what I believe in. Now, if you're an equities person and you're in the long run, equities are always a good place to be if you can stomach the volatility. But for somebody who is more concerned about the portfolio, is looking to park a cash which is sitting on the sidelines or in portfolios for a shorter duration and doesn't want to be a part of this volatility, I think there is a great investment idea out here, which is GICs. I never thought that I'll ever be preaching investing in a GIC, but the rates on a 1-year basis are about 5.5%. And that's a great return on an investment which is fully secure, fully guaranteed return, especially if you're worried about volatility and have cash on the sidelines. So that's where I wanted to conclude this update. I think it might be another choppy year. How choppy is it? There's a lot of data to watch and but despite all these choppiness, there are always pockets of opportunity. And this point of time, it looks like GIC might be the short-term place to park a cash, have a decent return, wait for things to settle down, and see how your long-term strategy is going to go unfold from there. Thank you so much for watching, and bye for now.